Not from Philadelphia, so we just stop in LA.
Yeah, maybe from Newark or something.
Mm-hmm.
Yeah.
All right, it's 1. I think I'm gonna go kick us off.
Awesome, let's get going.
This meeting is being recorded.
Hey, good afternoon, everyone. Thank you for joining us here for Financial Literacy Week, powered by UMortgage. Welcome to our Investing Basics session. We have a special guest with us today. It is Brittany Sennett. She is from Northwest Mutual and will be the expert here for our session. And I'm going to pass it over to her to take over and kick off our presentation.
Awesome, thanks Ryan. Hello and happy afternoon. Super excited to be here to be sharing just the basics of investing with you all, really to help put you on the right path to a great investment journey to help you grow your wealth and create financial security for you and your loved ones. Would love to learn who's joining us today. So if you want to drop your name in the chat, let me know where you're at, what you do for work. Would love to just see the type of people we have joining us today. And if there's anything on your mind, any questions in particular that you are hoping to get covered in this session, also drop those in the chat or in the Q&A, so that way Ryan and I can get to them either during the session or at the end when we have Q&A. So let's get started. A little bit about me. My name is Brittany Sennett. As Ryan mentioned, I'm a financial advisor with Northwestern Mutual, and I am in Philadelphia. So I'm joining you from my home office in South Philly. Hopefully you can't hear my baby crying downstairs. He's with my husband. But a little bit about me. I'm from Michigan, actually. Originally, I went to the University of Michigan for my undergrad. And actually, I moved out here to Philly for my MBA at Temple. That's a picture of me, my husband, my best friend, and her husband at a Michigan game at the Big House, actually playing Penn State. So super fun game, and I love Michigan sports, Michigan football in particular. That's a picture of my husband, Tom, in the middle. We got married during COVID. We actually had a pop-up COVID wedding in Rittenhouse Square here in Philadelphia the day after Christmas in 2020. And we just welcomed our first child. His name is also Thomas, and that's a picture of him on the far right. I just had him in early January. And then my little pup, Toby, he's at the bottom. Hopefully he doesn't disturb us. He came into the last session because he can open this door behind me. But yeah, that's a little bit about me. And I want to start my session telling you a little bit about why I do the work that I do and why I'm so passionate about sharing this knowledge with you all today on this webinar. My why is linked to my mother, and my mother in 2010 came down with a really rare cancer, and in 2011 she actually passed away. And I had just turned 25. I had just bought my first house, and then I actually had to help pay for her funeral because she didn't have any life insurance to cover her end of life expenses or to leave to me and my sister when she had passed. So When that event happened to me, I became determined to make sure that I didn't let the same scenario unfold for my family. And so I called upon the help of a financial advisor, actually at Northwestern Mutual, to help me build a plan to set the building blocks in place to create financial security for me and my future family. And long story short, that advisor introduced me to the business, and I actually quit my consulting job and became a financial advisor. And I now work with people every day to help educate them on their financial options and to create financial plans that are designed personally for them to help them meet their goals and help them live their dream life. So again, just thank you for being here and for allowing me to share my knowledge with you today. Let's dive right in. With baby Thomas, he says, Mom, what do I need to know before I invest my money in the stock market? So again, this topic is, or this session today is going to be about investing and investing basics. If you have questions during the session, feel free to drop them in the chat. I see a couple things coming through chat already. Let me just see if there's anything. I'm just saying a couple hellos and then nice. Awesome. So some people that had joined us from the earlier session. So let's dive right in. The stock market is a complex thing, and there's so much information out there that making sense of all of this can really leave your head spinning. Sometimes the market seems to be flying super high forever and then suddenly become crashing down and sending everyone into a spin. Kind of like the situation we're living in right now, right? With the market constantly going up and down with the situation happening in Ukraine. Conventional wisdom tells us that what goes up must come down. But even if you think about market volatility as a normal occurrence, it can be tough to handle when it's your money at stake. That's why I'm glad to be here, because the goal is to help answer questions on the minds of so many investors. How can I feel more confident in my investment strategy in today's changing world? And just like this says, volatility is a natural part of investing. One common theme I always tell my clients and really my friends and family is that we can always count on chaos to be present in our life, right? So how do we prepare ourselves to manage that chaos and the expectations of chaos, especially when we're designing investment strategies with our own dollars? So if you joined me for the financial planning basics session that happened just a little bit earlier today, some themes are going to be similar here in this session today. Getting to the core strategies that even large institutional investors rely on to help them navigate the choppy waters of investing. There's 5 strategies that can really change how you view the markets and help you become a more confident investor, regardless of the market direction. And first and foremost, you'll see step 1 is goal setting. That's the same place we started with building a financial plan that we talked about in the last session. You have to know where you're at and where you're going in order to build a strategy to help you get there, right? So first and foremost, we want to start building our strategy with your end goals in mind. Second, we're going to talk about balancing risk and reward. A lot of us have heard the terms greater risk means greater reward. Sometimes that's true, sometimes that's not, right? So we'll talk about the balance of risk and reward in the investment strategy. Third, we'll talk about the components of a balanced, diversified investment program. So not only where your assets sit, but the types of things you're invested in and how you can access them. Fourth, we'll talk about why discipline is so crucial to an investment success, in investment strategy success. And then finally, we'll learn how to build momentum in your investment plan. So let's dive right in. Yeah, you guys are all ready? I'm excited to get started. Let's dive in. And like I said, if you have questions, Ryan's gonna be watching the chat and the Q&A throughout, and we'll either take questions as they come up or address them at the end for Q&A. So a focus on core values, expert guidance, asset allocation, and investing fundamentals. These steps are part of the core values that guide how I invest with my clients as an advisor at Northwestern Mutual. We believe that expert guidance is invaluable when building your portfolio, and that asset allocation is the foundation of a diversified investment program. We also believe in the value of investment fundamentals, basic investment principles such as getting an early start, investing regularly, and using strategies that help reduce the impact of market volatility. As I said, again, there'll be time to answer questions at the end, and I have a little handout for you as well to leave you with at the end of this session. That's a packet to help you begin building your own investment strategy using the steps and the tips that I share with you today. So I want to talk a little bit about market declines because they are the main reason people shy away from investing. Think back to recent times when the stock market plunged just earlier this year. What did your gut tell you to do? Sell everything or hold on to it? A lot of people probably felt like they needed to pull money out of the market and put it into something that looked like a better bet. If you felt a little panicked, you're not alone. Market dives are unnerving, and the thing is that we have to just be real that market declines happen, right? In real estate, because we're powered by UMortgage for Financial Literacy Week this week, we often hear the saying, buy low and sell high in real estate. It's a similar philosophy we want to make sure that we're utilizing in our investment strategy. So let's take a look at how the markets have performed over time. You can see when you're looking at a single year of return, so these single bars here on the slide, it feels like there's a lot of dips, a lot of ups and downs. However, if we look back over 1 year, this is just investing over a 12-month period, 1 year, we'll see that there was positive returns 74% of the time. Now, this is looking back at stock market data back from 1926 to 2020. 1 year returns positive 74% of the time. Let's take a look at what happens over a 5-year return. Again, each bar represents the average return for the preceding 5 years. You'll notice that it's positive 87% of the time, a lot less red, right, in this 5-year return time period. While holding on to your stocks for the long term doesn't guarantee you won't lose money, let's take a look at the 15-year return chart. You'll see that it's been positive over 100% of the time. We've never had a single period of negative returns when looking across a 15-year rolling period using historic stock market data. So what does this mean? This means time in the market is way more important than trying to time the market. And by setting up a very disciplined and structured investment strategy where we're looking at the long-term view, we can help avoid making crucial, probably devastating decisions with our money that's driven by emotion, and instead focus on strategy and our end goals. So market declines, like I said, are a given, but there are ways to mitigate their effects in your portfolio. And the first step, like I said in the beginning, to a sound investment strategy is to figure out what your goals are. What are you trying to accomplish by investing? Some people might be just saving for retirement. Some are trying to save for their kids or their grandchildren's college funds. Some people might be saving to buy a house or go back to school. There are many reasons for investing, just like there are many investors. But if you haven't decided what you want your investments to accomplish, it's going to be difficult to know what you need to do to get to your goals, or even to know when you have arrived. Let's say you're dreaming about buying a vacation home for your family. If you just sit back and think about how great it would be if you had someplace to go in the summer, what do you think your chances of buying that property are? Probably not that great. But what if you make a list of amenities you need that property to have? Research prices for properties in the area you like, look over your financials, and figure out how much you need to save for a down payment. And also decide what you want to buy in 2 years. Probably a better shot at success, don't you think? And why do you think that is? That's because we're being very specific. We thought exactly about what you wanted, how long you have to get there, and how much time you need to reach that goal. When you know all of that, it makes it a whole lot easier to figure out what you need to be successful. Very simply, identifying your goals brings your future into the present, and knowing where you're headed can carry you through the emotional ups and downs that accompany challenging markets. Goal setting. So this philosophy holds true no matter what you're planning for. Let's talk about a goal that most of us think about at some point: retirement. Most of us want to retire, but what that means is different for everyone. Maybe you want to move to a different state or even to a different country. Some people want to spend more time with their families, focus on volunteering, or use their free time to enjoy their hobbies. All of those are very different pictures of retirement that require different funding to make them happen. So be specific about what you want your money to do for you. 1, your goal should be measurable. You need to estimate how much your dream retirement might cost. For example, you might analyze your retirement plans and decide that $500,000 will cover it. Great first start. 2, your goal needs to have a time frame, because saving that $500,000 means one thing if you're planning to retire at 65, and something very different if you want to be retired by the time you're 55. 3, you should figure out what your resources are currently available. For example, you might already have started a 401k at work or a Roth IRA. 4, you can start to identify the specific steps you need to take to reach your goal. For example, you might decide to increase your 401k contributions and put an additional $5,000 into your IRA. We use retirement as an example of a goal that you could have for investments, but having multiple investment goals is actually really common. So it's also common for you to change goals over time as your life evolves. That's why it's important to revisit your plan annually or whenever you have a major life event so that your investment plans grows and changes with you. And let's go to the next slide. 2, risk and reward. There's no getting around the fact that the markets can be risky. Investing is definitely a no pain, no gain endeavor. That's why the second step to investing successfully is understanding risk. This means protecting yourself against risk when you can, and when risk is inevitable, as it is with investing, knowing how much volatility you're willing to take on. A strong foundation starts with risk management. Things like car accidents, house fires or floods, medical issues, disabilities, the need for long-term care, these types of things can throw a huge wrench into your financial plan. No matter how strong your investing strategy is, if you have to stop and use those invested assets for something else that you weren't planning for, that's going to affect your ability to reach your goals. For example, if you're injured and had to pay for unforeseen medical expenses, and you didn't have enough money in your emergency fund, you might have to pull money from another place, like your 401k, to pay for an unexpected hospital bill. Once recovered, you have to build those funds back up to get back to where you were before the injury. If you missed work because of an injury, you also might be missing on an income that you rely on for your regular expenses and investments too. So rule number 1 is always to protect yourself first. And insurance is actually a topic that we're talking about at 3 p.m. today. So there's ways we can protect ourselves through insurance. There's also other ways we can protect ourselves with additional cash funds. So we want to make sure that we're protecting ourselves appropriately where we can. We have a saying that we plan for the unexpected so we can take advantage of all the good things that can also happen to us. So a strong investment strategy also has conversations around risk and risk management for the plan. What's your tolerance for risk? Anytime you invest, there is risk involved. Nothing is a sure bet, but everyone's tolerance for risk is different, and that's totally okay. There is no right or wrong level of risk tolerance. At Northwestern Mutual, with my clients, I use a personal investor profile to help investors understand how they really feel about risk. And it looks at a bunch of important factors, such as your investment time frame. That is, how long your money will be investing before you need it, when you're ready to start using those funds, and how long you'll be making withdrawals. This is called your withdrawal timeline. How much of your money is already in safe assets or predictable assets, like maybe permanent life insurance, pensions, savings, Social Security. These are usually considered more stable, and we want to take them into account when building our investment strategy. And there's also other questions that I help my clients figure out too, such as personal liquidity needs, income stability, and how personally you feel about market volatility. How you answer all these questions together helps you know your personal risk tolerance and what that means as you're investing. It also gives you more confidence when evaluating your options. So on the handout that I'll be providing to you, and I don't know if it's been dropped in the chat yet already, there's actually a page dedicated specifically to the personal risk tolerance. So you can take a little bit of a more in-depth view into some of the questions that I discuss with my clients. And if you're interested in talking about any of those results with anyone, I'm happy to set up time with people so we can talk about that at the end. All right. Stock market performance by decade, taking the long-term view. Knowing how much risk or volatility you want to accept is a big part of this picture, but it also helps to recognize that the returns look a lot less volatile when you view them over a longer period of time. That's because over the long term, periods of high returns tend to offset periods of lower returns. Let's take a look at this chart. It shows how the S&P 500 has performed each decade since 1950. If you look at each decade separately, there are a lot of dips. But in 70 years, the S&P 500 has ended the decade with a negative return only one time, and it was positive again the following decade. The trend is for the market to increase. And you can see that even though the market does drop at times, staying invested over the long term helps reduce the risk of loss in the long run. So again, it's not about timing the market, it's about time in the market. Step 3, diversification. So we've talked about identifying your goals and understanding risk. Now let's talk a little bit about diversification. Developing a diversified investment program. Today, investors have a huge number of options to choose from, different assets and investment vehicles, all available from hundreds of financial service providers. And where you invest your money depends on what you're trying to achieve, your risk tolerance, how long you're investing, and what your investment options are available to you. Diversification is splitting up your investments into different assets so that you're not putting all of your eggs in one basket, so to speak. Finding the right combination of different investments to meet your goals in a way that suits your unique investing needs. So there's a number of different asset categories, and asset allocation is exactly what it sounds like. It's how you allocate your assets or split up your funds between different assets to create a diversified portfolio. It doesn't have to be complicated in order to work, but it should include at least 2 asset categories to be effective. That's because each asset category has something unique to contribute to your long-term investment plan. Equities, such as stocks, typically offer the greatest long-term growth potential, but they also have a higher risk level. Fixed income securities have other benefits and detractors. Bonds are a good choice for income, while cash alternatives such as money market funds provide liquidity and stability compared to other asset classes. So one thing I like to think about with my clients, and the way I explain asset diversification often, is we don't want all of our money in similar things that move in similar ways as the market moves up and down. We want things that move down as some things move up. Another analogy that I like to use is, if you're on a boat, you don't want all your oars on one side of the boat, because if a wave comes from the other side, the boat's going to get knocked over. So you need oars on both sides to make sure that you can ride the waves that come you from either direction. So that's what asset allocation is all about, setting you up in a diversified perspective so that you can weather the storm of the market wherever it's coming from. Asset allocation models. So how many of you have heard of things like conservative, moderate, or aggressive models, or you heard that language when it comes to investing? When we go through the risk analysis or the risk assessment profile with my clients, we then map their risk outcome to an allocation asset model that we then use for overall diversification in the plan. So it seems like when the markets are going through a rough patch, there are always some people who lose a lot of money in confidence, and then there are others who sail through barely touched by market losses. Why do you think that is? It's not just that some investors are lucky or that they know some secret that gives them an edge. Those investors who do well understand diversification and asset allocation. As I mentioned earlier, different asset classes have different benefits and drawbacks, and they tend to react differently to economic activity and market trends. So combining them can help provide investors a balance between expected risks and expected returns. Sometimes stock returns are up while bonds returns are down, and vice versa. When combined, these offsetting movements help to reduce overall risk in the portfolio. The asset allocation models shown help represent possible combinations of stocks and bonds. Even though bonds are considered less risky than stocks, notice that even the most conservative risk portfolio has a mix of different asset types. That's because diversification is key. Although historically, yeah.
Sorry to jump in. We had a question in the chat that seems relevant right now. What is treasury bills?
T-bills come from the government. So those are, let me see actually if I have that on, oh, I don't have the other. Let me see if I can find, I have a definition sheet that I can share, but essentially a treasury bill is you taking, you investing in like the debt of the United States, and the treasury bill, it's like a bond and it has a rate of return that's associated with it, but you have to hold it for a certain amount of time. So T-bills are generally considered pretty safe because the thinking is you know, who's going to bet totally against the United States market. So those are part of kind of like the fixed income part of the overall portfolio, which also includes other bonds and cash and cash alternatives. It's because it's a U.S. backed asset. The United States is considered a very strong asset class, I guess, or they promise to return on that bill, if that makes sense. I need to find the definition page. I'll pull that up here at the end, Ryan, and we can take a look at that together, because it explains all the different asset classes more clearly. So good question. Any other questions you want to address right now while we're in the asset allocation? There's another slide, actually the next slide, that I think will help probably hit on some questions that might be lingering in people's minds, so we can address that. So this is a fun slide. You're probably looking at this slide and going, oh my gosh, what the heck is this? And this is an illustration of the point that I said earlier, which is time in the market is more important than timing the market. So this is, we call this like the periodic table of investing kind of. This is a look at market performance by asset class over the past about 15 years. So each square color represents a different asset class. And what we're showing here each year is the rate of return that asset class got in that year. And you can see that oftentimes the highest performers in one year sometimes end up as the poorest performers the following year. So let's play this out like you're talking with your friends, right? You meet someone and, you know, they're talking about their investments in real estate, how, you know, real estate's really taking off. And so you decide that you want to get in on real estate and you're expecting that to be a really high performer. But the next year it's down 17%. And then surprisingly, this is 2008, right back when the market crashed. Fixed income, which was the lowest performer, one of the lowest performers in 2006, ends up right at the top in 2008 as the market crashes. So again, going back to that saying in real estate where you want to buy low and sell high, emotionally, when we think about how we want to get in the market from an emotional standpoint, most people want to look at the highest performers and put all their money there, place their bet on the highest performers. But with a diversified asset allocation strategy, we actually take the middle road, this diversified portfolio, the white square. So we're never going to hit the home runs. We're not going to be at the very top, but we're also not going to be at the very bottom, completely crashing, right? So our point of view and the point of view of most successful investors is to invest with a diversified portfolio where we own a little bit of everything in the proper ratios based on our risk tolerance to make sure that we're capturing the highs of the market, but keeping that in balance with not losing everything when the market drops. So I have a definitions page that I don't have on this slide, but I can pop that up in a little bit. We can look at that stuff together. But yeah, the question is, can you predict which next year's winner is going to be? Probably not, right? Which is why we want to invest with a long-term view and own a little bit of everything so we can capture the highs as they come. Any questions on this slide, Ryan?
We did have one question pop up from Sylvia here, and it is, when I buy stocks, do I have to spend my days watching the ups and downs of the market?
Super good question. And so that's where I think getting back to the goals is really important, and why we say investing with the long term in mind, because I don't know who asked the question, how old they are, but let's talk about retirement, for example. If retirement for someone is happening 20 years down the road, the daily fluctuations, what's happening each day, within a certain amount of movement up and down, probably doesn't, need much attention unless there's really, really major swings in the market, because you have a 20-year timeline until you actually need to access those dollars. And that's also probably why, the people that are most successful in investing and invest with a long-term view, they're also not probably freaking out, right? Because they're making appropriate moves and changing the allocation of their portfolios to meet their timeline. That's another thing that's important. Let me go back to the other slide. People might start, if they have a longer term time horizon on an account, say a retirement account. If you're young and you still have 20 or 30 years to retirement, you might be invested aggressively in those accounts right now. But then over time, as we get closer to that retirement date, we actually move that portfolio down in risk, because you're going to need those dollars as you get closer to retirement. So that's, again, why it's important to understand the goal for what you're saving for or investing for, the time horizon to meet that goal, because over time, as you get closer to wanting to meet it, you want to know the money's there. And so you might take a more conservative approach to that portfolio than if you had more time, you could take a longer approach. So I hope that kind of answers the question that was asked.
Yeah, we did get one follow-up question as well. So Brandon asked, with the age group being 22 to 25, what is the average percentage you can invest aggressively?
So that's another kind of heavy question there, because I don't know anything about your income or your, how you live, what you spend each month. Typically, and we talked about this in the earlier financial planning presentation, we talked about saving or investing 20% of your gross income. And actually, I have some other backup support slides in here that might be helpful. So we talked about in the financial planning webinar earlier, using about 20% of your income to save or invest, and to kind of stretch those dollars across different areas of your financial plan based on your financial goals. So to the person that asked that question, I would start, trying to save 20% would be like the overall goal. But then depending on what your goals are across, your life, if you're 25, you have 40 years until you're 65. Retirement is super far away. Now you have time on your side to make the most out of those dollars, but you probably also have a lot of things that are going to come up in your life in the shorter term or midterm or long term. So you're also going to want to make sure you have money available to help you spend for or to use towards those goals. So understanding your goals, understanding the timelines, quantifying those goals from like a dollar perspective, that's going to help you bring into view where your dollars should go and what strategies you should be using to help your dollars grow and help you achieve those goals. So to the person that asked that question, without knowing more details about you, your goals, your income, your expenses each month, things like that, it's hard to give you like a very specific answer. But I'd say in general, where I'm working with my clients to put 20% of their income to work for them to help them meet their goals in the most efficient and strategic way possible. So super good question. I hope that was a good answer for you right now. All right, Ryan. Should we keep going with the slides or any other questions?
No other questions right now. You're good to go.
Okay, cool. We can always come back to slides if questions pop up. Discipline, step 4. This can be the hardest part for some people, right? Discipline. So we just talked about how timing the market isn't a great strategy, right? But it's not surprising that investors still make emotional decisions, jumping in and out of investments in the hopes of getting the best returns. No one wants to lose money, even in the short term. So let's take a look at this. This chart shows how missing the best trading days in the stock market over a 20-year period affects your returns. I've actually seen this as like a meme on Instagram or TikTok recently as well. So maybe some of you have seen this as well. Being invested in the whole time gives you a 5.5% return. Not bad, right? But if you try to time the market and end up missing out on the 10 best trading days in those years, that return actually drops to below 2%. 2% is around what we can expect bonds to return. So not even, performing as well as bonds. If you miss out on 20 or more of the best trading days, the portfolio actually loses money. And since large ups and down days tend to be clustered together, by trying to avoid market dips, you could easily miss out on the great days too. That can have a big impact on your portfolio actually in the long run. So this is actually answering your question that was just asked. When you start to see the market shifts and you get nervous about your investments, it takes discipline and sometimes a lot of discipline to resist the temptation to try and avoid those bad times. It takes discipline to sit back and trust that over time, your diversified plan will do the work it was designed to do for you. Now, that's going to work assuming that you've designed your strategy around a specific goal over the proper timeline and that you're properly diversified and your allocation is correct based on those parameters, right? So sit back. If you have the time on your side, sit back, trust the process. And again, I can't say guarantees because no one on this call controls the stock market, right? But historically, looking back in time, taking the long-term view is going to set you up for success. Now, actually, this chart also maybe gets back to the question that, was his name, Brian asked between ages 22 to 25. So this is a chart that's actually interesting. Not sure what your actual goal is in investing over the long term, but to accumulate $1 million by age 65, if you're 25 years old, you need to invest $381 a month or about $4,500 a year to grow those dollars to $1 million. Now, if you wait until age 35 to try and reach that same goal, you have to more than double your investment a month, over $820 a month, almost $10,000 a year to grow those dollars to $1 million. So you'll see the dark blue is the total dollars you're putting in. If you start earlier, it's a much lower contribution. The light blue is the total growth of those dollars. So you get the biggest growth when you have the longest time horizon available to you to help you reach your goals. So maybe this also illustrates, Brian, the question that you asked earlier. I don't know exactly what the right amount is for you to be investing, but if you're trying to reach $1 million by age 65, here's a potential chart that might help you understand how much you should be investing now based on your age. Any questions on this slide before I move on to step 5? Awesome. Well, holler at me, Ryan, if any questions come up. Momentum. The 5th step is simple. Let your plan build momentum. Now, let me ask you a question. How many of you on the call exercise? I know it's been a struggle for me. Actually, I'm just getting back into exercising after giving birth. But here's what I found. As much as I hate to, put on my running shoes, that's always the hardest part before a run, right? It's actually putting on your running shoes. I always feel better when I do. And the more I exercise, the more energy I seem to have. And the more energy I seem to have, the more likely to keep exercising. Bet you see where this is going, right? Reinvesting your investment earnings, which is crucial to compounding we were talking about and looking at in the earlier slide, creates the same kind of momentum as exercising. And that's because when you allow your dividends to compound over time, your investment earnings are building more investment earnings. Income-producing investments are key to this approach. They can help keep your investment plan on track even during market declines. Why? Because historically, many companies have kept paying dividends at the same rate no matter what the market is doing. Bonds and money market funds also provide a steady stream of interest payments, which can help cushion your portfolio during periods of market volatility. So reinvesting your income is a key component to boosting your returns. This chart compares the hypothetical growth of $1,000 invested in stocks and bonds over a 20-year period, with and without reinvestment. Reinvesting allows you to capitalize on compounding, which means you earn income on the principal investment in addition to the reinvested dividends and coupon payments. If you compare the stocks with the reinvestments to the stocks without reinvestment, you can see that your returns on that $1,000 are about 2% higher if you reinvest. With a $1,000 investment in bonds, it's 2.6% higher if you reinvest. So whether it's stocks or bonds in your portfolio, reinvesting that income can actually help you maximize the growth of your overall portfolio. Keep in mind that total return represents capital appreciation, income, and reinvestment of income. And as mentioned earlier, government bonds are guaranteed by the United States government. So that's what the T-bills are, while stocks are not guaranteed and have been more volatile than bonds. Questions on this slide? I know there's lots of lines and numbers on this one. I guess the other note to make here is a lot of people maybe have heard the term dollar cost averaging, which is a fancy term for just setting up recurring deposits into your investment account. So investing consistently each month or each week. And so that's also an important part to kind of building momentum in your investment strategy, reinvesting, the dividends and the income that you earn from your investments, but also setting up a consistent dollars going into your portfolio so that you're constantly adding and adding and adding and building momentum that way as well. All right, so let's recap the steps to investing. Step 1, set your goals and be specific. Step 2, understanding risk and reward and properly managing risk, right, in your overall strategy. Diversification, using the principles of asset allocation to develop your strategy and taking the time really to understand, your level of risk tolerance and what that means for your overall diversification strategy. Step 4, discipline, ideally investing with the long-term view in mind. And step 5, building your momentum, letting the progress build on itself. There's a lot of information and noise out there about the markets. Even when you feel comfortable with the basics of investing, it takes time to make sense of all of it. And it's difficult to be sure you're making the right choices to be successful. And that's why it can be helpful to work with a financial professional, someone whose job it is to know about all these concepts we've talked about and more. You want someone objective who can help you wade through all of the information and create a sound investing program to grow and manage your wealth and incorporate that into a strong financial plan that helps protect what you care about most. And someone who is committed to providing you with continuing support to help you stay on track. A trusted guide can lead the way to a sound investment program. And to be honest, as a financial advisor, the plans I put together for my clients, those of course are very, very, very valuable. But as we saw in a couple slides earlier, if you pulled out of the market during those 10 or 20 crucial investment highs and lows in the market that saw those big returns, often those are the times when we want to manage with our emotions and not with a sound strategy. Being the voice of reason on the other side of those really tough times with my clients is sometimes where I can add the most value. I'm kind of like a coach during those challenging market declines to help coach my clients through sticking with the strategy, building trust in the diversification and the strategy that we build, and really, using time while we have it on our side to wait out the volatility in the market until things come back, rather than pulling out and reacting really emotionally when the market gets volatile. Go ahead. No, the rest of this is just about me and Northwestern. So I think we can take questions now.
Okay, we did have a question popped up about kind of like towards your guidance. So Laura asked, is it safe to assume that your returns are reinvesting unless you actively take the money out of the account, or does this happen automatically?
Yeah, that's a super good question. So that's an option that you'll choose with your financial advisor when you're building out an account, or if you're opening an account yourself, how to use the dividends that happen. They can either be reinvested or you could take them out. So that would be an option that you discuss with your financial advisor or at the time that you open the account. Yep, good question. I'm going to pull up my slide here too. As I mentioned earlier, I build out strategies for a bunch of clients. And again, where I can add a lot of value is not only in the actual planning process, but just being a support person and a coach for my clients during some of these more volatile and challenging times. So if you're curious about what investing might look like for you or what a holistic financial plan might look like, happy to sit down and chat with you and offer free consultation to people on the call. You can learn a little bit more about me, my approach to investing, and see if we might be a good fit to work together. So you can email me, find me on Instagram, or book time directly on my calendar, either using this link at rebrandly.ly/umortgage or scanning the QR code to get time on my calendar. So, other questions?
Yeah, we do have a couple questions that are popping up in the chat. We'll start with Valerie, who asked one through Q&A. Are I bonds a form of investing?
So I bonds, they try to guarantee a type of return in your portfolio. And I guess the other thing we should mention too, maybe in this question, is things like crypto, right? Which you have a session happening, Ryan, on crypto, I think tomorrow, right? And NFTs. There's a lot of different ways that we can put our money into different vehicles that we can, expect to get a return out of. Real estate is another one, right? That you could also invest in real estate, even though it's not necessarily on the stock market. So the answer is yes. All of these are different forms of investing. Some of them are in the stock market, some of them are not. And what's great about the work that I can do with my clients is we can take into account all of these different kind of strategies and approaches. Again, understanding what your overall goals are to make sure that there's a proper balance to these different strategies so that you're putting your money in the right places to help you achieve the goals within the timeline that you're hoping to achieve them. So Valerie, I hope that kind of answers your question. Same, like I said, similar to crypto. Like crypto is not something that's on the stock exchange. It's not like a security, but you can still put your money in it. It's a currency that's that's growing in value. And another example of something that we can look at and compare, put in the overall portfolio, make sure that we're putting our dollars in the right places based on your goals.
Thanks, Brittany. And we have one more that popped up from Sylvia. She says, the only funds I have available is $36,000 in a retirement account that allows me to withdraw from. I'm $61 YRO, and this is the only savings. Would it be unwise of me to use some of it to invest?
So I guess I would need a little bit more clarity, and Sylvia, maybe we should set up some time to chat about this specifically for you. But if you have dollars available in your retirement account, so one thing about your retirement accounts, like if you have a traditional, retirement account, you typically can't access those dollars until 59 and a half. And then once you're over 59 and a half, you can, get access to those dollars. But if they're in a retirement account right now, like in an IRA, you should have investment options within that retirement account. So, so that would be one place to check, is just to see if those dollars are currently invested. But, I think again that this question, we would need to check to see like what kind of emergency fund do you have in place right now? What, are you currently working? How long do you expect to work? And kind of go through some of that other, questions to make sure that, if that these dollars don't need to be used in another area of your plan to help you achieve your goals. Typically with my clients, and let me pull up this slide or this page I had earlier. When I'm sitting down with my clients, we're talking about investment strategies. We want to make sure that we're covered for the short term and we don't need those dollars in the next 1 to 2 years. And so like any cash that we might need if we're trying to buy a car, or put a down payment on a house, or have dollars for our emergency fund, that a lot of that stuff is sitting in cash because, if we're investing for just a year or two, chances are we're taking on more risk than maybe we want to. So I'd want to understand, what's the timeline of your goals? And then we can start looking at, for things that are more than 2 years out, what's the right investment strategy to help you reach your goals. So again, without knowing a little bit more information, Sylvia, about your situation, I can't give you a super clear answer, but happy to set up time with you if you'd like to chat about it one-on-one.
those are all of our questions for now, but definitely encourage if any of our audience has questions to leave them in the chat or the Q&A.
Yeah, I'm just looking back at some of the questions, sorry. Yeah, and let me see if there's anything else. Awesome. So, just to kind of like recap, I think, actually, there was one other, I think Sylvia was the one that also asked about the T-bills. How are we doing on time? Still doing good? Okay. There's a page in here that I can show you quickly. So I showed you that one slide that showed the kind of periodic table of investments, right, with all the different asset classes. And then there's a page here with all the different definitions in that as well. So I'll have to check and see if that made its way into the deck, but I don't think it did. Oh, here it is. It is in here. Just showing you the different definitions for the different assets in that table. So I can leave that on here if you want to read that for a sec too. So again, thank you for the time and for joining the call today, the investing basics. If you missed the financial planning session that I did a little bit earlier, investing is one strategy that I talk to my clients about within a holistic financial plan, where we're taking a look at, a lot of different strategies there to help them reach their goals, whether they're for retirement or, for the shorter term in the next couple of years. And then we have another session happening at 3 p.m. today focused on insurance. So taking a look at the risk management within the financial plan and just some different things, definitions, and topics within the insurance landscape to make sure that you're, addressing any gaps that you might have in your financial plan to protect you and your loved ones from any unforeseen events or circumstances. And then Ryan, tomorrow, correct me, you guys are doing sessions on crypto and NFT, blockchain, those type of topics. So again, not necessarily securities on the stock exchange, but other areas that people are starting to invest in, emerging areas that might be of interest to you all as well.
Yeah, so those sessions are actually happening this evening. So we have crypto and blockchain taking place at 4:30 this evening, and then NFTs at 6 p.m. this evening. And also, Brittany's going to be back with us one more time. She's doing insurance and preview that session a little bit at 3 p.m. today. So we're really looking forward to having you back one more time today. And, just as an awareness thing for everyone in our audience as well, is that, these sessions throughout the entire week have been recorded. We're going to replay a lot of them over the weekend. You can see that in our schedule. And like Brittany talked about, like share it with friends, family, loved ones who you might think like, oh, maybe it'd be good for them to see this, or you want to sit down with a loved one and both watch it. So you can come back and watch these things again this weekend. But with the last few minutes we have left, I'll pause just for a second, just in case there's any more questions. I think I did see a new message pop up, and so Sylvia asked about the recorded session. So we'll be recasting them a lot this weekend. You can see the schedule for that. And then once this whole financial literacy week is over on Sunday, we're going to change around our landing page a little bit that you came to and access those sessions to put some resources. So we'll put the recordings, once we get them all compiled, we'll edit them, trim some of the, get them all just tiled in, and then post them so you're able to see them. But is there any final questions before we do wrap up?
Yeah, there's no other questions. The only other thing I can share, Ryan, is, getting back to the question that was asked earlier around, if I'm investing my dollars, do I need to be like watching the market all the time? Like, that's where where working with a financial professional is really helpful, because we can leverage different strategies to make sure that, your portfolios are properly diversified and then change over time. And so one thing that I'm working with a lot of like pre-retirees on right now is they have some stuff that is actually maybe invested too aggressively. And they're like, oh my gosh, I need to start talking about how I diversify or restructure these investments to help them as they're preparing for and leading into retirement. So That's a topic that's really popular with a lot of my clients right now. And then I meet a lot of people that are sitting on a lot of cash because they're really good savers, and they're just scared about moving money into the market because they just don't know what to invest in. So they freeze and they do nothing. And, you know, what's that Chinese proverb, like the best time to plant a tree was like 1,000 years ago and the next best time is now. So that's, I work with a lot of my clients and educating them on, all the topics we covered today, and building in the strategy at a pace that's comfortable for them. So they start to move money into the market and get more comfortable with the concepts of investing. And that way their dollars don't just sit losing value in the bank in times of high inflation like we're in right now. So yeah, if the topic of investing has been something that's been on your mind, like I said, happy to sit down and chat and see how I can be a resource to you, so you can make sure you're moving your money into the market with confidence.
Yeah, that's a really good point to wrap us up on. So, one, thank you, Brittany, for being here. This was an amazing session. Thank you, everybody else, all our participants who are in the audience asking questions, just being here. We really hope you gained a lot from this session. We hope to see you back at 3 p.m. for our next session, which will be insurance, again with Brittany. So thank you and have a great day.
Thanks, all. Take care.